I'm going to set out each of these key judgments in turn, and then I'll conclude with the implications for monetary policy. The first key judgment is that disinflation in underlying domestic price and wage pressures is generally continuing, albeit to different degrees. Headline inflation is likely to pick up slightly further in the coming months, but we do not expect this increase to persist. Chart 1, which has just come up, shows the development of 12-month consumer price inflation since 2021, that's the white line, along with its components, which are the coloured bars. The largest driver of the rise in headline inflation over the past year has been energy prices, which are no longer pushing inflation down. You can see that in the orange bars, while the contribution from services price inflation, which is the yellow bars, has remained elevated. More recently, higher food price inflation has also contributed to higher headline inflation, and that's the purple bars. In the shaded area, the chart shows how we expect headline inflation to peak at about 4% in September. In addition to the contributions from energy and food prices, inflation will continue to be held up over the coming months by a number of increases in regulated and administered prices, such as water bills and vehicle excise duty, that are not directly linked to underlying cost pressures in the UK economy. There are good reasons to think that this rise in headline inflation will not persist. Now, as chart 2 shows, excluding the impact of administered prices, there has been some further progress on disinflation and services inflation. Inflation in services prices that is more directly linked to cost pressures in the UK economy has therefore continued to ease, albeit gradually. And pay growth, a key component of cost pressures in the UK economy, has declined further recently. Increase in the upside risk to inflation makes the second and third key judgments underlying our decision today all the more important. And these key judgments have not changed since May. The second key judgment is that a margin of slack has opened up in the UK economy and the labour market is continuing to loosen. While we expect it to pick up a little in coming quarters, growth in the UK economy remains subdued. Employment growth is weak, and the ratio of vacancies to unemployment has fallen further. Surveys of capacity utilisation suggest growing spare capacity within firms. And here, risks are more to the downside. While real household incomes have risen over the past couple of years, consumption has not followed suit. The saving ratio remains notably above pre-pandemic levels, and we have for some time been expecting it to decline and support consumer spending term. Accordingly, as chart 4, which has just come up, shows, conditional on the market implied path for bank rate, inflation returns to the 2% target in the second quarter of 2027 in our baseline projection and remains at target thereafter. There are risks on both sides of this projection. The extent of the shift in global trade patterns and how this may come to affect external pressures on UK inflation remains uncertain. Recent domestic news suggests that the risks to inflation have shifted slightly more to the upside. The near-term peak is likely to be a bit higher than we previously expected, and the risk of second-round effects means that it may take somewhat longer for inflation to return to target. But at the same time, there are slightly more risks on the downside to activity. I do think the path continues to be downward. There are all sorts of, we've included a box on restrictiveness. There are all sorts of views on where the neutral rate might be. I'm in the camp of people who sort of thinks that's rather too uncertain to speculate on, but I think it's very important to sort of talk about the whole idea of restrictiveness, and we've put a lot in there about how we assess it. And I do think policy is still restrictive, even when we say we're past the peak. Of course, that's a comment on, if you like, on the level, as it were, and that not the direction might be sort of be less restrictive, but the level can still be and is still. We're telling a story here really that we've got an upside risk, which is really a sort of can be more directly mapped into inflation. It goes to the previous two questions actually, but we've got a downside risk, which of course gets to inflation via weaker activity, weaker labour market story, and we are balancing those two risks. Now, I think the path has become more uncertain,